The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, my name is Jillian Schaefer and I'm the Marketing Coordinator for SWK Technologies. I'd like to welcome you to our webinar, How Employee Retention Credits, ERC, Impact Your Business, presented by Matt Ferreira and Brad Porras of BDO. A little housekeeping before we get started. Everyone has been placed on mute to keep the background noise down. However, you can submit any questions you have throughout the webinar. To submit a question, look for the questions section in your GoToWebinar. We will answer all questions at the end of the presentation. We are recording this presentation and it will be distributed tomorrow to all attendees as well as to those who registered but were not able to attend. Please take a moment after the presentation to answer our one survey question. And as a reminder, SWK's 2021 Virtual Empower Conference is coming up on May 4th through 6th. Be sure to register to learn how to get the most out of your Sage ERP. The registration link will be sent in the webinar follow-up email and I'll include it in the webinar chat. With that said, we appreciate you taking time out of your busy day to attend our webinar. We're here to help you get the most out of your software solutions and help you find an easier way to run your business by providing you software and industry knowledge, tools, and support whenever you need it. So whether you're here doing research for a new solution or you're just here to learn, we'd like to encourage you to ask any questions throughout the webinar. Lastly, as a quick reminder, SWK is constantly sharing important updates and software tips and tricks on our social media channels, so we encourage you to follow us on Twitter, LinkedIn, Facebook, and subscribe to our YouTube channel. Without further ado, I'll hand it over to Matt.
Perfect. Thanks so much. And you can see my screen okay?
It hasn't come through quite yet. I think you need to click on it. Might be a preview. Perfect.
Did it come
That's great.
Awesome. Well, I appreciate everyone's time today. My name is Matt Ferreira, Managing Director here with BDO. The goal for today is really to talk through the employee retention credit and the value that it can provide to both your company, your clients, anybody that you might be interacting with. So really, I think the goal for today is to introduce the idea and the topic of what the employee retention credit is, how it works. I think this is probably one of those topics that you guys may have heard of before. As a result of COVID over this past year, it was one of those provisions that was written into law through the CARES Act, where this past year we've probably seen the most changes to the employee retention credit. And so depending on the type of year the time of year that you looked at it, depending on the type of business that you're in, the rules have changed quite a bit. So what we're going to do today is really walk through kind of the chronology of the credit and how it works and the cash value that it can provide to your company. And so, with you today, there's a couple of presenters. So there's myself here, Matt. I'm, like I said, a managing director. I sit within BDO Southwest region. So I'm in the Dallas office, but kind of cover the entire Southwest United States. Carolyn Smith Driscoll, you see her name there. Actually, let me switch the slides here for you. Carolyn Smith Driscoll is a managing director out of our West region. She sits in our Orange County and helps cover LA and the whole West Coast. She's actually, we had to make a last minute change, so she's actually not presenting with us, but she still is a point of contact if you are on the West Coast. And then I can turn it over to Brad real quick to let him introduce himself.
Yeah, thanks, Matt. So my name is Brad Porras. I am also a managing director and lead our Northeast region's business incentives group. Similar to what Matt was saying, I think the intro that I would also give is ERC, and you'll hear us use that acronym quite a bit. ERC has been a really hot topic and something in which many industries have eligibility, and to the extent you have eligibility, it's been something where, frankly, for the past 4 months, ever since the credit was extended into 2021, not to give a spoiler on some of the content that we're going to be talking about, but our phones have really been lighting up with a lot of questions, and gaining an understanding of who's eligible and working through some of those misconceptions is usually the first part. The second part is, to the extent that you're eligible, this has been a really big incentive and lifeline for a lot of businesses, organizations, that were impacted from COVID. So we look forward to educating you guys on this and making you guys ERC experts as well.
Perfect. Thanks, Brad. So, you know, the employee retention credit was written into law, you know, last March as part of the stimulus provisions that were written in order to, you know, try to help keep employees on companies' payroll, right? And so the real, I mean, it's in the name, right? The employee retention credit to retain your employees. What the government was trying to do was find a way to keep cash in taxpayers' hands versus having those employees going into the unemployment line, you know, receiving unemployment benefits, healthcare benefits. There's all sorts of, you know, unintended consequences of mass unemployment. And so I think, you know, a lot of people have heard about the PPP loan and some of the other provisions. I think back in kind of early 2020, that was the one that probably got the most fanfare. It got the most, you know, news attention. The one that didn't get as much attention and has been, like Brad said, probably the last 4 or 5 months that's been picking up a lot of steam is the employee retention credit. So when it was first written, or when it was written into law, it was actually written as a payroll tax credit. So we get questions on, well, you know, is this an income tax credit? Do we need to be paying income tax? You know, we had a lot of companies had a down year in 2020. So that's not even a factor here in looking at the employee retention credit, because it's a fully refundable payroll tax credit. It is something where, you know, if we calculate a credit of, you know, 100,000 and your total payroll tax was 10,000, well, that excess 90 is a fully refundable payment that would be coming back to, you know, your company or the taxpayer as a result of this. So it is a fully refundable tax credit, regardless of, you know, the amount of tax that you paid in there. You know, a couple of bullet points down there, it's really going to be based on wages and health plan costs that were paid to employees. It says there between March 13th, 2020 and December 31st, 2020. When they first wrote the credit, it was set to expire at the end of 2020. Since then, there's been a couple of extensions of the credit. Brad will walk through that in a little bit more detail, but just so you guys are aware, this credit is now effective both from a retroactive perspective for 2020, so we can go back and get refunds for 2020, but then it was also extended through 12/31 or December 31st of 21. So we're obviously not through the full year yet, but there is going to be an opportunity for companies to take advantage both for 2020 and 2021. When we're looking at the 2020 credit, the credit is based on, like I said, the eligible wages and allocable health plan costs, up to $10,000 of wages and benefits per employee. And then the credit itself is 50% of those qualified wages. So you're seeing up to a maximum of $5,000 per employee as a refundable payroll tax credit. So it's a pretty sizable benefit depending on the number of employees a company has, and depending on a number of other fact patterns. But to Brad's point when he kicked it off, this is a great lifeline, or it's a great cash infusion for a lot of companies, because as you can imagine, you know, $5,000 per employee, and the benefit goes up in 21 that we'll cover here shortly. You know, a lot of cash opportunity here. So then the comment there in red off to the right, you know, in order to take advantage of the employee retention credit, there's really 2 eligibility tests that you have to meet one of. So there's a couple of rules that a company would have to meet in order to be eligible. Before we go into those eligibility tests, what we always like to cover is, you know, what are we seeing in terms of who is claiming the employee retention credit? And I think when you guys see the tests on the next slide, you'll kind of understand a little bit more. But really anybody that was, you know, impacted due to COVID, right? Whether that is a decline in sales or an impact due to a government order that impacted, you know, business operations, right? So the industries that we see here, retail, technology, gaming, healthcare, hospitals, right? hospitalities, auto dealerships. I mean, there really is no industry that wasn't impacted to some degree by COVID and the really everything that's gone on in the last 12 months. And so, we list out nonprofits, so schools and museums, right? Really anybody who had any sort of impact from COVID should be taking a look at this because of the potential cash savings opportunities. And so, we included just one comment there from an industry perspective of, well, hey, we were deemed to be an essential business, whether that's from a local ordinance, federal ordinance, whatever governmental agency might be in place, wherever you're located. We were able to still operate our business to some degree or some capacity, or, we're essential. So we didn't necessarily shut down and just send everybody home. Can we still claim this? The answer to that is absolutely yes. Any company, essential or non-essential, should be looking at and evaluating the employee retention credit.
And Matt, if you don't mind, I'm gonna throw one or two examples that we're witnessing on that topic, and also talk about the industry. So in the Northeast, I'm doing quite a bit of work with hospitals. So as everyone probably knows, hospitals are an essential business. So they were allowed to continue operating. However, this just gives a sense of how you can meet that test for essential businesses. There were elective inpatient procedures that were restricted due to government orders that enables a hospital to be able to include certain employees in their calculations. Another good example is we do a lot of work with construction companies, and depending on some of those local government orders, we'll get into the government order tests in more detail, but some of those government orders in different localities allowed for essential construction to continue. So we have some non-essential construction, we have some essential construction, but we saw instances where potentially a construction company had equipment that they couldn't get because the pandemic, there were some supplier issues. So if they were unable to get access to that equipment, and there was a 1 month delay or 1.5 month delay, that's something where in many instances there was eligibility to claim the credit as well. So it's really just thinking through your business and thinking through your industry and seeing, was there a period of time where there was an impact? And it doesn't need to be for the entire year. It could be during a certain portion of time in the year, especially that first portion from mid-March until usually early June, depending on where your business is located. There tended to be the most stringent stay-at-home orders and restrictions in place that opened the door to eligibility. So that's what I'll say. Matt, feel free to get back to it.
No, and I think that's a good lead into really, well, what are the tests? How do I get eligible for this credit? And so I said before, really, it's kind of one of two tests. So it's not an and test. You don't need to meet both of these. You just need to meet one or the other. And so the first one there is that if an employer's operations were fully or partially suspended due to a government order related to COVID-19, right? So that's the exact example that Brad was just going through, where let's say a hospital, or I think the easiest one for a lot of people to understand in this case is a restaurant, right? We work with a lot of franchises and restaurant chains, and their dining room and still, I think in some locations still aren't able to be open. They could have drive-through, they could have takeout, they could have online ordering, but they were still deemed to be partially suspended because a major, a nominal portion of their business was impacted due to this, dining room not being able to be open. We work with a few technology companies where they've got software and hardware, and a lot of the hardware, like Brad gave in that construction example of, well, they're impacted because of their supply chain has now been disrupted because one of their suppliers hasn't been able to provide the type of critical material that they need in order to deliver their product. Really, I think every industry, depending on software, technology, hospitality, construction, churches and museums, like everybody has been impacted to some degree. And so to Brad's point of, hey, this doesn't have to be for that full time period. Even if there was, strict orders in place for a certain covered period, it could be something where we look at this for a few months of the full year. It really depends on facts and circumstances. But to the extent that you were impacted due to any sort of government order, this is one of those two tests. The second test is a decline in gross receipts test. And so how this works is you look at any one quarter in 2019. So what we're trying to do is say, how was your business operating pre-pandemic? And then using that same calendar quarter in 2020, and we want to see that there's a 50% decline in gross receipts. So for example, we would use Q2 2019, compare that to Q2 2020. And if there's a 50% decline in revenue, then that's going to be your eligibility point, and get you eligible regardless, even if there was no government order in place, even if maybe you didn't shut down, operations. But if you meet that decline in gross receipts test, which a lot of our companies do, and a lot of companies that we're talking to obviously had major impact, if it rises to that level of 50%, at least as it relates to the 2020 credit, it's something to look at as well. This test is 50%, depending on the company, depending on your clients, that could be a pretty large decline. Obviously, I will say that again, Brad will touch on this, but this is one that's going to change for 2021, and it's going to be a 20% decline in gross receipts. So not to get too far ahead, but if you're like, hey, I'm not going to meet a 50% decline, we've been fairly business as usual. There is some pretty big updates coming for 2021. I'll touch on this slide briefly. So if you meet one of those two tests, so the impact due to a governmental order or a decline in gross receipts test, what we always like to at least make a note of, depending on a company structure, depending on the ownership, we do want to at least make you aware that there are some aggregation rules. There's a couple different code sections that we have to look at. One looks at, let's say, ownership percentages. One looks at the types of shared services that could be taken, that could be in place between two different entities. And so when we're looking at the decline in gross receipts test, right, we want to make sure that we're looking at it on the aggregated basis. Generally, it's companies greater than 50% owned are going to kind of fall within this. It's very facts and circumstances, so we can help walk you through that. But when we look at the impact due to a governmental order test, you may have, let's say, multiple companies within your organization. Depending on the type of impact, you could have, let's say, one business, one location, a portion of the business that was impacted due to government order, and then maybe the rest of the business wasn't, right? Depending on the nature of that impact, that one entity or that one location or that one portion of your business that was impacted could actually push your entire company into eligibility. So it's actually a good fact pattern to, when you're looking at this, looking at really the business holistically from an ownership percentage, and making sure that we're really evaluating all of the different areas, both from a gross receipts decline, but also from a government order impact type situation as well. And then as it relates to the gross receipts test, we often get questions on what is the definition of gross receipts that we have to use. The definition that the IRS provides to us is it's listed there. It's 448, but really it's meant to be an all-encompassing definition. So out to the right, we've got some bullet points there, but it really is meant to include all of your revenue. But if there's any interest, dividends, rents, royalties, other income, in the event that that's applicable for a company, we want to make sure that we group that in together, right? And looking at that gross receipts test, we would hate to have maybe revenue decline 50%, but rents and royalties maybe didn't, and so we may not meet that when we're using this more broader definition. So it's just making sure that we're using the right definition of gross receipts. And then for tax exempt organizations, so if you guys are involved in any sort of Boys and Girls Club or any church organizations or nonprofits or for those types of entities, there's the definition there under 6033 that it's meant to provide a similar type definition, something that's more all-encompassing, and so just making sure that we're taking advantage of it. The last bullet point there is one that's, I would say, commonly overmissed or overlooked and missed when looking at this. So to the extent that any of you guys have foreign operations, whether that's a foreign parent, a foreign sub, any sort of foreign activity, those foreign gross receipts do need to get brought in and included as part of that decline in gross receipts test. Something to call out, something to evaluate. It may work in your favor, right? If you've got foreign branches and foreign locations that were hit harder than maybe the US location, it actually could work to your advantage to get you guys eligible. So definitely want to call that out and bring it up to the extent that might apply to anyone here.
And Matt, just adding one more thing on here. One question that we often get and is clearly explained in the IRS's notices that address this topic, there's no requirement for the reduction in gross receipts to be directly attributable to COVID. It's something where, to the extent, looking year over year and looking on an apples to apples basis, factoring in acquisitions, dispositions, any major changes to the business in terms of acquiring of entities or dispositions again. It's something where if there was that reduction in gross receipts for any reason, looking quarter over quarter, you're eligible irrespective of the reason for it. And I'm just giving one example. Life sciences companies are typically not one in which you would think there would be large reductions of gross receipts during COVID, as a lot of them were very active in kind of creating some of the things to develop vaccines and therapies and treatments. However, I know in the Northeast, there's a company that I'm working with who they had, just as the facts aligned, in 2019, they lost exclusivity to their drug that was an FDA-approved drug, and their gross receipts were very high in 2019 and then dropped off as generic drugs hit the market, replacing the product that they had. They meet the gross receipts test, and just off of that alone, their credits for 2021, as we'll get to when they're increased, were almost $2 million for the first quarter. So it's a pretty significant benefit that could be available just based on the rules and how they're written. It's really meant to capture businesses that were most impacted and have a very binary way to look at it, that if your receipts drop by a lot, the definition was that you were clearly impacted by COVID, but it does sweep up other companies and businesses. And even to that example, pre-revenue companies who have very de minimis gross receipts, there could be small swings that make them eligible if they have barely any revenues and had a drop due to a few various reasons. So it's just something to look out for and see if you happen to meet the eligibility.
Perfect. And so, step one, right, figuring out if you meet that decline test or the impact due to governmental order test. And then if you meet that or you fall within one of those categories, then the question is, well, how do you calculate the credit? So if anyone's looked at it, they've probably heard that there's different employee headcount thresholds, whether you're looking at 2020 or 2021. For the 2020 credit, that threshold is 100 employees. And when I say threshold, I don't mean that determines eligibility. What it does is it changes the way that the credit has to be calculated. So as long as you meet a decline in gross receipts or an impact due to a governmental order, you're going to be an eligible employer. So if you have 100 or fewer full-time employees, then all of the wages that you pay to those employees, and we'll go through a little more about what those wages and benefits are, but all of the wages that you're paying to those employees can count towards this eligible wage bucket, right? And then keep in mind that the credit is 50% of those eligible wages. So it's up to a max of $5,000 of credit per person. So in this example, if you have 99 employees, and they're all making at least $10,000 in wages and benefits, and they're going to cap out each employee, you're going to see a $495,000 benefit just as it relates to 2020. And then Brad will go through 21 here shortly. Now, if you're over 100 employees, the way that the credit is calculated is based on the wages that are paid to the employees who are not able to perform a service due to COVID, during that period of eligibility. And so what this means is, right, when there's those orders in place, or when you kind of meet that decline in gross receipts test from a quarterly perspective, during that time period, what Brad and I and our teams do is go in and actually help companies quantify, right, the wages that are being paid to employees versus the service or the hours that people were able to work, right? So if you've got sales folks that are out typically traveling, meeting with customers, meeting with clients, and now they're only able to stay at home, take meetings inside. They're not able to travel. They're not able to perform the same level of service or work the same amount of hours. Or you have a certain location or facility that was shut down, even if it was only for a certain period of time, right? That time where that facility or that location was shut down, but those employees are still receiving a wage, is time that can be counted towards the credit here. I'll say in this calculation, if you're over 100 employees, something else to keep in mind, and same thing, we'll touch on this more in a bit, but we're seeing a lot of companies, a lot of our larger companies with maybe well over 100 employees, when they got into March, April, May, they likely furloughed a lot of employees. And so that in that type of situation, right, there's no work being performed, there's no wages being paid, but they might still be covering part of their healthcare costs and plan. And so those dollars can add up pretty quickly. And so if there's large amounts of furloughed employees, even if you kept everybody else on payroll and everybody else was working the same amount of hours, that's one other area where we're seeing quite a bit of companies being able to capture qualified expenses that go towards this credit. Off to the right, so some of those additional provisions, I'm going to go down to the second one there. So it says the ERC was not available to employers that received a PPP loan. So when the credit was first written, the PPP loan and the employee retention credit were mutually exclusive. So if you got that PPP loan, a lot of companies didn't even look at the employee retention credit, which is why I said when we kind of kicked it off, the PPP loan got in the news, they got all of the fanfare, and that's what everybody was going after. Part of the update that came that first extended the credit was making companies that received a PPP loan now eligible for the employee retention credit, both retroactively and prospectively. So I do at least just want to kind of take a stop there, make that comment, because regardless of what you did with your PPP loan and if it's been forgiven or not, this is something that still can be looked at and evaluated. Now, with that said, there is some interplay with a lot of the different credits and incentives that were written as part of the CARES Act. So wages that go towards ERC generally are still going to be mutually exclusive to those wages that were forgiven by the PPP loan and by some of these other credits that we've listed out there. So there is some planning work that can be done if you guys are taking advantage of the second round of PPP funding. It's probably worth a conversation to figure out how we can really maximize your loan forgiveness, but also your employee retention credit, because all of these do have some interplay with each other. And so what we do is kind of help model out and really make sure that you're maximizing all of these different benefits and all these different provisions. So common questions on qualified wages. So that 100 employee headcount definition is the same rules that were used under the Affordable Care Act, the ACA. So what we see is that being, employees that work at least on average at least 30 hours a week or 130 hours a month during 2019. So when we're looking at whether it's the 2020 credit or the 2021 credit, that employee headcount is going to be based on average full-time employees in 2019. So if you have 120 employees, but 30 of them are part-time, they don't work 30 hours a week, they're going to drop you under that 100 employee threshold. And so then all of the wages now that are being paid to your employees, right, are going to be eligible towards the credit. So very important to understand that the definition of full-time employees, as we look at and evaluate, right, all of those types of employees that we can potentially remove from your headcount, because the lower that we can get that headcount, generally the better off we're going to be, because we'll be able to get you under that the 100 or 500 employees, depending on the year that we're looking at here. And so we see this, it kind of depends on the industry, in the hospitality space, right, with restaurants, you might see that. Manufacturing with part-time help, part-time work, being in Dallas and in the Southwest, in the energy space, we see that quite a bit. So something to look at and really make sure that we're looking at and capturing your headcount correctly. Let's see here.
And Matt, just one thing to, again, I'm just interjecting here and there, but one thing where this has been really critical for any companies or businesses where there are a large number of part-time employees, although on the surface, the thought of the over 100 or 500, as Matt had mentioned, seems pretty clear, where there's quite a number of employees that are over that count. When actually looking into it and seeing how many were over or under that 130, we often find on a month-by-month basis, it could be a very different story, and there are a lot of those differences from the ACA rules. I mean, just using another example, one of the organizations I'm working with, they put on seasonal events, and they at times have up to 1,000 employees that are working for them, and then during the course of the year, it's maybe 100 employees in total. And just the timing in which that event happens, it's mid-month from August to mid-month September, and a lot of those seasonal employees never hit the 130 hours in the given month. So it really does get nuanced, and it's something to evaluate to see where things stand.
Yep. And so similarly, for the, or I should say, to continue on with common questions on the qualified wages, looking at some of the qualified health plan expenses. We've got some examples in here for fully insured, self-insured. I think what we want to do is just make sure that companies are aware of how this can impact their credit. Like I said before, we really start with the wages and the impact of the wages, but really maximizing the credit through the healthcare plan expenses as well. Like I said, the biggest area where I see this coming into play from a nuance perspective is when you have those furloughs, like I mentioned earlier. So if you've got a large number of employees, I've got a company here in the Southwest in Texas that they've got about 400 to 500 employees, and they furloughed over 100 employees through the entire 2020 year. The rest of the employees that they kept on staff were still working at capacity. I mean, the reason why they furloughed them was so that they wouldn't have to pay them, and they kept everybody's hours operating at capacity. And so those 100 employees that they furloughed, The company was still covering their full healthcare costs and plan with the intention of eventually bringing them back onto payroll. And so we're able to help them capture and claim the employee retention credit, at least as it relates to 2020, primarily based around the healthcare costs, even though no wages were necessarily paid to those employees. So, we can kind of talk through, or you guys can kind of see there some of the different definitions and the premiums and what we can take a look at. But there is definitely a lot of value add in looking at your healthcare costs as well. And with that, I can turn over to Brad here to talk us through how to claim the credit, and then some of the updates and provisions that came out that expanded the credit through the end of 21.
All right, great. Thanks, Matt. So in terms of how to claim the credit, this is a credit that is IRS administered. I know we talked about this at the beginning, as opposed to SBA administered, where the PPP program is done. And the IRS administration is all done through the payroll tax return. So primarily your 941s that are filed on a quarterly basis, to the extent that and most organizations and companies were not able to claim these timely. To the extent you could claim it timely, especially going forward, knowing that there's eligibility, if you know the answer to that eligibility question, this is something that could get filed on an originally filed 941, your normal payroll tax return. There are lines for both the non-refundable and refundable portion of your employee retention credits that you file on that 941. That's the easiest way in which it's claimed. However, because this was just merely viewed as a mechanism for getting the cash in the hands of the companies, they did introduce other methods in which you can attempt to recoup the costs in a quicker manner. And when we say a quicker manner, the typical process of filing an amended 941, that 941X, that is anything but quick right now. It's something where those are paper filed returns, and there are very long turnaround times right now. That typically is the method for filing any prior quarters. Again, companies and organizations have 3 years from the date in which their originally filed 941 was filed. So looking to the earliest quarter in which the companies and businesses were impacted, Q2 of 2020 for the most part, that's when it was first introduced on that form. You have until July of 2023 to file an amended 941 to claim these credits. Just be forewarned that the process, as I mentioned, it is very, very slow right now. And we're seeing anywhere from 4 to 8 months of time before these are actually getting processed. So it's something where patience is a virtue with a lot of these. But to the extent you're out ahead of it and in front of the ability to claim it, know that you meet the requirements under the gross receipts test, or there's a current government order in place. There are really 2 mechanisms for claiming the credits on a faster timeline. One is, in anticipation of actually receiving the credits, employers can talk with their payroll providers and tell them to actually hold back any remissions that would normally go to the IRS. And the idea of that is, if you know, based on the number of employees you have and what the likely credits are going to be, and start calculating it before the end of the quarter, you could essentially say, we think that there's $500,000 of credits in Q2 of 2021 that we're expecting to get. Talking to your payroll provider, in many instances, they can hold back not only the FICA taxes that usually these credits offset, but all federal taxes that would normally be remitted to the government up to that amount that you think it will be. And by doing that, it's that exercise of, rather than handing the IRS $500,000 and at the end of the quarter saying, oh, by the way, can you send back the $500 I just sent you? You're essentially retaining that amount of the credits, and then when filing the 941, you're just reconciling the amounts. That's one method. The other is, they introduced Form 7200, which is an application for a quick refund, which allows companies to request a refund in the midst of a quarter as the quarter goes along, and it's something where that advanced refund, which is only available to small employers for 2021, that's under 500 employees, as we'll get to. That's another mechanism to attempt to file the credits and get access to the cash in a quicker manner than the amended 941 process. Okay, so here we're talking about retroactive changes that were passed. After the CARES Act was passed at the end of December, when the Consolidated Appropriations Act, or CAA, was passed, it had a few really large changes to ERC. And I'll just hit some of these really quick. The first one is, as we mentioned before, to the extent that you claimed a PPP loan previously and were not able to claim the credit, now the door is open to go back to 2020 and potentially claim ERC during that same period of time, even if you took a PPP loan. And there's a lot of mechanics to this. There's an art and a science, but fundamentally, you're able to pick up any eligible wages before the loan kicked in, after the covered loan period ended, and then even during the covered loan period, if there were excess wages, typically companies are able to pick up that delta between the total wages during the covered loan period and the wages used towards satisfying that PPP loan. So that's the first major change. The other one really was just codifying the rules that health plan expenses can be included as wages. This was something that back in May and June, when the IRS was issuing guidance, they allowed health plan expenses to be included as a wage. This just codified that idea that health plan expenses can be taken as part of that $10,000 wage cap. Okay, so continuing along, the first one's pretty straightforward. It just defined for tax-exempt organizations, so for nonprofits, what are gross receipts? It really just spelled it out, as this was a vague definition. It really just follows tax. That's the easiest way to describe it. So looking at your 990, it's all the same items from a gross receipts perspective. And then the applicable quarter to claim the ERC. This week, we could skip this one because it's something where it's just talking about some mechanics of things. Prospective changes. So there were a few really large changes. We hinted about these, but here's what they are. Since the passage of the CAA, and then when the American Recovery Act was passed in mid-March, which extended the credit to the end of the year, here were the large changes, and we'll talk about the old and the new. So one, credit was extended to the end of 2021 for all successive quarters. Number two, the credit percentage amount, where it was a 50% credit of any qualified wages, they upped it to a 70% credit. So where we're talking about $5,000 in credit, now it's $7,000 in credit for 2021. Continuing along, the wage amounts for qualified wages and health plan expenses, where previously for 2020, this was a $10,000 limit for the entire calendar year, so up to a $5,000 credit per employee. When extending the credit, this now became up to a $7,000 credit per quarter for each quarter within 2021. So for 2021, to the extent that your business or organization qualifies during the entire period of time, there can be up to $28,000 in credits if $40,000 or more in wages were paid to an employee that are fully refundable over the course of the year. So it became a really big benefit. And then the other really, really big change, that definition of what's a small employer or a large employer. Previously for 2020, small employers were defined as 100 or fewer full-time employees. In 2021, they matched the definition initially given by the SBA and said that if you are under 500 and under an employees, you're now deemed a small employer. So if you recall that idea of if you're under 500 employees for 2021 and qualify based on either the gross receipts test or the government order test, you could pick up all wages paid to your employees, not just the wages in which they weren't performing services. And then Matt, if you go to the next slide, this is the last big point that's coming. This is a really big one, which is that gross receipts test, which was greater than 50% of a reduction when comparing a 2020 calendar quarter to that same quarter in 2019. Now, for 2021, we still look at 2019 as our baseline. So it's still a pre-COVID baseline quarter, but that reduction now only needs to be a 20% reduction in gross receipts. And I can't tell you how many companies and businesses in 2020 had pretty big impact. It was less than 50%, but certainly over 20%. Now, in many instances, there is eligibility, as so long as you have a greater than 20% decline in gross receipts, you are able to claim the credit for that calendar quarter. And then even with the way some of the nuances work of this, there was a provision that they put in place, and it was a safe harbor. And the idea of it is, and it's a little bit tough to explain, it's written out on the slide, but the idea is, let's just look at Q1 of 2021. So Q1 of 2021, to the extent there was a 20% reduction of Q1 2021 versus Q1 of 2019, you'd automatically qualify. If you didn't have a 20% reduction, there was a safe harbor built in which allowed you to say, if I look at the immediately preceding quarter, so the quarter before that, Q4 of 2020, compared those gross receipts to that of Q4 of 2019, if that had a 20% or greater decline, you'd automatically qualify for Q1 of 2021. So what does this actually mean? What this means is for 2021, Q1, let's say the company had a 20% reduction in gross receipts, you will automatically qualify not only for Q1 of 2021, but also for Q2 of 2021. And combining that with that employee headcount test, if you're under 500 employees, and we have many instances where some of the companies we're working with have 300 employees, and if they are under the, so that they're under the 500 threshold, and if they meet that gross receipts test, and most to all the employees hit 10,000 in wages, we're talking about somewhere between 1.9 to 2.1 million in credits for each of Q1 and Q2 of 2021, just off of that 20% decline. So again, the ERC was meant to, when they changed the rules and made it much more generous, it was meant to be a replacement to the PPP program, as PPP is now, it was passed for one last time, and for the most part, it's likely going to sunset out for the rest of the year. This was meant to be a replacement, as they made PPP harder to qualify for and ERC easier to qualify for. Okay, so the next slide. Okay, so these are just two other nuances. I touched on the advanced payments one before, but for pay rate increases, this is a bit of a nuance. For 2020 purposes, qualified wages paid to any employee couldn't exceed what they would have been paid 30 days immediately preceding that suspension of time. It was meant to say, if you increase someone's wages during that time, we couldn't pick up the increased wage amount. For 2021 purposes, this changed and opened the door to things such as hazard pay, bonuses, increases in wages for certain employees, and really just streamlines the processes. For 2020, there is a lot of nuance in making sure that we're picking up an appropriate amount of wages when calculating credits. I mentioned the advanced payments before. It's the idea that previously for 2020, any employer could have filed a Form 7200 application for quick refund. For 2021, it's any employer under 500 that can. So this is just one other little nuance as well. In terms of eligibility, for any 501c1s as an example, government entities previously could not claim ERC. Now it's something where colleges, universities, or some of those others, it was codified that they are eligible. It's a brief point, but we just wanted to throw this in here as well. This is probably the biggest topic especially for companies who took a PPP loan. and it's the idea of the interplay between ERC and PPP. As we mentioned before, although ERC is now, you can now claim the employee retention credit even if you took a PPP loan, fundamentally the double dipping rule applies. It's the idea that you can't double dip and claim ERC on the same costs that were included for PPP purposes. So it's something where it's a little bit of an art and a science in figuring out how to maximize both opportunities. And that's where our group has worked on a lot of efforts in trying to do so, where in figuring out that covered loan period, there are some opportunities, especially if the wages during the covered loan period exceeded that of the actual wages paid exceeded the amount of your PPP loan. There are opportunities to maximize both benefits. And then the other thing I would mention is, and we get to this a little bit on the next slide, there are other ways to minimize the wage expenses that get included for PPP loan forgiveness, which increases the amount for ERC. So think of it as a Venn diagram. There are certain expenses that are not ERC eligible, but are allowable for PPP purposes, and vice versa. So there's a bit of a figuring out how to maximize both credits while first and foremost ensuring that you get full loan forgiveness of your PPP loan. So that's kind of the big thing. We point out some examples here, but as I mentioned at the beginning, in most instances, the earliest time period in which a PPP loan fund, the loan funds were actually received, from all the work we've been doing, usually it's mid-April. We're talking April 10th to the 15th was the earliest date. But in many other instances, what we're calling round two of draw one, organizations and companies receive their funds first week of May. There are opportunities to maximize that initial period of time where there were huge spikes in uncertainty, and there were periods of time where, depending on your industry, employees were really being paid and not performing services. There are ways to maximize your ERC benefits while not affecting the forgiveness of PPP loans. So we just spell some of these out. And then really these are just some of those best practices are. What we have been advising is you have up to 100% of your PPP funds, PPP, three Ps, that can be used, and for PPP purposes, up to 40% of them can be non-payroll items. So think of things such as rents, mortgage interest, utility expenses. That's a best practice to the extent that when filing for that loan forgiveness, including as much of those expenses as possible allows you to only include 60%, or at a minimum 60%, because that's the required minimum, of your wages towards PPP loan forgiveness. What that does is it kicks those out and makes them potentially ERC eligible. So that's a really big practice, both for 2020, as companies still, if you haven't filed for forgiveness yet, have the ability to change their paperwork and do that. If you've already filed for forgiveness, you're not able to amend that paperwork. However, still it's something where you could look back and see if there's any opportunity during that covered loan period. So that's the first bit of guidance that we have. The other thing is that forgiveness period, we tend to recommend taking as much of the time as possible as it stretches out the period of time in which you're able to gain forgiveness, and opens the door to those first few weeks when the most stringent orders were in place. So as I mentioned before, let's just say in that first draw, you received your loan in mid-April. From that mid-April to the end of May period of time, in many instances, there were still stay-at-home orders that existed depending on where your business is operating and located. And those are typically areas in which we find a lot of ERC eligible expenses. If you just took the 8-week period of time and were able to fully satisfy your loan, a lot of those expenses may be off the table. By taking the 24 weeks, it likely allows you to be able to utilize some of those expenses during that time period for ERC purposes, and then you're getting that dual benefit. The other last two items that we have here, and this one's pretty critical. When the IRS issued their formalized guidance and provided Notice 2021-20, they really specified what types of substantiation requirements or documentation is needed to show that you are ERC eligible. And it's not just the quantification of the numbers, it's also things such as why was the company eligible? Why did you either meet the gross receipts test or what government orders applied? And from a best practice perspective, gathering a lot of that information now and upfront while your HR teams and legal teams still have their minds around what type of impacts were in place is definitely a best practice, because again, 3 years of time that the IRS wants you has to actually look back and potentially audit any of these claims. 2 years from now, it's going to be a lot more challenging to start pulling that documentation together. So it's a really good idea to get a sense of how to document these claims, have that quantitative documentation in order showing that you're not double dipping on the same expenses during those time periods, show why the organization and company is eligible. And even if you meet that small business requirement and it's pretty clear that most employees are going to hit the $7,000 credit, we still think it's prudent to show those calculations on a per pay period basis, whether it's weekly, bi-weekly, semi-monthly, and show how you're reaching each of those credit amounts. And the last thing I would say is we, at BDO, we work a lot with our PPP team to optimize that process. And in working with them, there's almost a feedback loop of optimizing what expenses get included for PPP purposes, what expenses get included for ERC purposes. And that's shown an ability to really maximize the amount of both incentives and maximize the credits that are available. So Matt, I don't know if you want to take us home here, but this is just some links to some of our thought leadership pieces that we put out there.
Yeah, and I know that the slide deck and the presentation will be passed out to everybody. We just include this here to let you guys know that there are links. There's a lot of resources available around the employee retention credit. I mean, even if you just Google BDO employee retention credit, we have an entire landing page with all of the links to this. So if you want to do that, sooner rather than later, feel free to do that. And then the last slide that I'll bring up here is just our contact information. We would love to talk with each of you guys around any questions that you have, exploring opportunities. Like I said, this is being part of the credits and the incentives team here at BDO. This is what Brad and I do 100% of the time. So all of the nuance, all the detail, we covered a lot of information today. And so, feel free to give us a call, shoot us an email. You can include, all of us that you see here on it. You can shoot an email just to one of us, whatever's going to make the most sense and you guys are going to be the most comfortable with. But we would love to work through any opportunities that you guys might have in really claiming credits both for 2020 and 2021. I'll kind of leave you guys with this. The employee retention credit is definitely probably one of 10 things that Brad and I work on. So if you have credits from a tax perspective, from a credit perspective, how else we can help save money outside of the employee retention credit, we can probably answer a lot of those questions as well. So really any question that you guys have around tax, accounting, employee retention credits, any others, feel free to reach out on that as well, and we can help work through it. Otherwise, appreciate the time. And like I said, I know it was a lot of information to cover. It's very valuable, something that, each of you guys should be taking a look at. But really appreciate all you guys spending the hour with us today to walk through all the information.
Thank you so much, Matt and Brad. We'll now open it up for questions. If you have any questions, please enter them into the questions section of your GoToWebinar. And just a reminder, everyone, we do have subject matter experts here. This is a great opportunity to have your questions answered in real time. And Matt, we did have a couple come through during the presentation. The first being, you are only talking about 2020 now, correct? In 2021, we only need a 20% reduction quarter over quarter, right?
Right.
Exactly. Exactly, yeah. So there, you may not meet that 50% decline test for 2019 compared to 2020, but if you do meet that 20% decline test for any one period in 19 compared to that same period in 2021, it's definitely something to take a look at. So even if you don't meet that for where you're currently at, but maybe your projections for the rest of the year, right? Q2, Q3, Q4. Definitely something to monitor through the rest of the year. So yeah, it absolutely does change for 21.
And we have another that's come through. Does the 50% reduction in gross receipts have to be for a calendar quarter, or can it be for any 3 consecutive month periods?
Calendar quarter. Yeah.
Calendar quarter, yep.
Simplest answer.
And we have one more. Are there any companies or industries that are not eligible to receive ERC?
No, I think any company, as long as you fall within and meet the eligible employer test, so the decline in gross receipts or the impact due to governmental order test, all industries and all companies should be taking a look at it and evaluating it. Absolutely.
Yeah, the only thing I can think of, governmental and certain governmental entities, but I don't think that would apply here. Even common questions that we get, PE-backed entities are ERC eligible, where initially with PPP, there were limitations on PPP. Those limitations have never existed for ERC.
Perfect. And that looks like all the questions we have, so give me one moment as I take back screen control and close out the webinar. Perfect. So thank you so much, Matt and Brad, for your informative presentation and for taking the time to be here today. And as a final reminder, don't forget to register for Virtual Empower to learn how to extend the value of your Sage ERP on May 4th through 6th. The registration link will be included in the webinar follow-up email. Thank you everyone for attending our webinar. Have a wonderful rest of your day.
Thank you again.